Thanks, guys, for being here. What we're going to work on today is a couple of setups. So let me start off by saying that I guess there are two schools of thought when it comes to holidays. One is that somehow the market magically just changes and, it's different and in whatever way, shape, or form people feel that it's different. And in terms of volume, that could very well be true. It's not really going to, it's not very common that it's going to pick a direction and just ride it out, right? We're looking at like April. It may very well like bull down or bear up, or vice versa, right? In one direction for long term and, break record highs and lows. Where for the most part, there are instances in November, December where we might just consolidate. But consolidation could be like within a 100 pip range, right? And so the first message that I want to deliver to you guys is that if you have a system and a strategy that you've back tested, don't deviate from it just because it's November and December. I don't change anything about my trading strategy in November and December. But I know that it's so prevalent that we have a symposium that's called Trading Strategies for the Holidays. So why they picked me for it, I don't know. Thank you, Ashley. I love you. So, but I will say this: whatever your strategy is, whatever is working, whatever you've back tested, that's what you want to continue with for the holidays, right? How many countries celebrate Thanksgiving?
One or two. Doesn't Canada do it as well?
Yeah, it's like,
Not the same day, no.
yeah. So Thanksgiving for us, right, which is going to be a week from yesterday, or in a couple weeks, whatever. We celebrate that, right? Christmas is something that there are multiple countries to celebrate, and then New Year's is hit or miss. So there are a few holidays in there, yes, and of course you got to consider when the banks are going to be open, when the volume volatility is going to be present. But isn't that true on Tuesday at noon, right? So if you're trading on Tuesday at noon, then it's you're going to experience the same type of volume and volatility at times during the holidays, right? And you might get some swings back and forth. For the most part, you're going to get that consolidation. However, if you try to deviate, then what you do is you risk scrapping your whole trade plan or your whole trade strategy in exchange for 1 month, right? So some people say, well, I'm just not going to trade in December. But in my experience, take it or leave it, I just don't change my strategy. I use it the same in December as I would the rest of the year, and it works just as effectively. So the key to that is knowing your strategy. It's not just being able to identify it, right? So there's 3 steps that we always take with our members. One is identifying your setup, right? So how many of you guys can identify your setup? Do you have at least one that you can identify? Good. 2 is knowing when to execute, right? So you know your setup, you know when to pull the trigger, right? And the 3rd is how to execute that trade. And that's not just like going to MetaTrader 4, press the buy and sell button, set your stop loss and take profit. It's knowing what your lot size should be, what your stop loss should be, what your take profit should be, right? And there's correct answers for that, and there's a million incorrect answers. So I want to make sure that we're all on an even playing field and we're all talking about the same things here, because I think sometimes we get distracted and deviated. We deviate from the overall message by nuances, right? So let's just dispel some things for a moment. And the last symposium we did, we talked about, how many of you guys were here for the last symposium? Good. So you guys remember we talked about, and actually it wasn't the last one, it was the last one that I was at, sorry. How many of you guys were here for that symposium? Okay, good. Similar people. So in that one we talked about how more pips does not necessarily mean more dollars, right? How many of you guys have heard advertisements on, because now that you're day traders, you start getting advertisements for day traders. You guys realize that, right? It's creepy. It's weird. And so you hear about 2 things when people are advertising about day trading: win percentage and pips or movement, right? Stocks moving high amounts, or high pips, high ticks, whatever it might be, right? Just depending on what market they're trading on, right? It's not always pips, obviously, but let's just talk about pips for a moment since we're looking at the Forex market. So one thing that I like to just dispel and get off the table right off the bat is the fact that the amount of movement that you have in the market is not relative to the amount of money that you'll make, unless the risk-reward ratio is present, is enough to justify so. I'll give you an example. Let's say that, and we won't break down all the numbers because we may at the end, but let's say that you have a lot size of 0.01. Okay, how many of you guys know what a lot size of 0.01 is worth per pip? 10 cents. Okay, so you have a lot size of 0.01 and you move 100 pips. How much did you make? $10. Okay, what if you have a lot size of 0.1 and you move 10 pips? So hold on. You're telling me that 10 pips is worth the same as something that's 10 times its size? Right. They're both worth how much? $10. Now, in terms of overall value, which one would you say is worth more? It's kind of a loaded question. They're the same? They're not. Can you take a 100 pip trade every day consistently? Can you take a 10 pip trade every day? Probably multiple times a day, right? So which one's more valuable? The 10 pip trade. There is never going to be a scalping. If you do it right, you're never going to find a long-term approach that is going to outdo a scalp approach. I haven't seen one yet, right? Because the holy grail is minimal drawdown, huge gains, right? Because then that could justify a higher lot size, right? But that's not the case. Generally, if you have a small drawdown and a huge gain, it's because you're just letting it ride and you're smoking the hopium that it's just going to continue to go up and up and up. And then somehow, the shooting stars and all the stars of astrology, and you're going to open up a fortune cookie and it's going to tell you to get out of the market at the perfect time, right? No, it's not what we do. Well, it's not what I do. I don't know. Some of you guys are like, yes. But I really like Panda Express. I trust those guys. All right? Okay, so the point is that when you have that scenario where you've got very small drawdown and huge gains, you don't win often, right? So you've got like a 30, 40, 50% win rate. Now, because that percentage is so low, you have a high likelihood of having back-to-back losers, okay? So if you have a high likelihood of having back-to-back losers, you have to consider what is probable. And if it's probable, then it's going to happen at some point, right? So then you plan for it at every single trade. So if it's probable that if I could get 10 losers in a row, then I'm going to make sure that my lot size is not going to be as such that if I do hit those 10 losers in a row, it's going to draw my total account balance down to 50%, not even 30%, right? Or not even 20%, whatever that number may be for you, right? Because if you don't, then when you do run into that situation, not if, but when, you're done. Somebody just cashed your check, you're done, right? Okay, so we've got to begin with the end in mind. If we take that approach, then we can't use very large lot sizes to take a whole bunch of pips, right? Okay, now let's talk about win percentage. A higher win percentage doesn't always equal more dollars either, right? It all comes back to proper money management, proper exit strategy. Your risk reward determines what that's going to be worth. Knowing what your risk reward and what your risk percentage should be for a win percentage and making sure that your risk reward makes sense mathematically is the foundation of being a professional day trader. If you only write down two things today, and I say this all the time in these symposiums, you only write down two things today, you write down these two things. What is absolutely imperative and consistent in every successful day trader I've ever known, and I know a ton. I go to international traders expos. I chop it up with the best of them. Some of these guys are millionaires, and I've talked to them. They have no use for our system. When I talk to them about our system, they're like, it took me 6 to 7 years to figure it out, and then from there 2 years to get wealthy, right? So it was like 9 years before I got wealthy. They're like, you're spoiled. You did it in a year to 2 years, right? I don't even know how that's possible. So, that's with this program, right? And they say, well, it took me 6 to 7 years to do what I've done. I'm comfortable with it. I've made millions of dollars with it. I'm going to stick to that, right? And so I always pose the question, well, what if I showed this to you 6 years ago? Well, yeah, hands down, bar none. I mean, that's what people are selling for $300,000 and yada, yada, and so on and so forth. right? And that's the facts, guys. If you guys don't know what this stuff is worth, holy cow, what they charge for it. I mean, the symposium that we did in Orlando, by the way, I've met people, and I have people sign up in my organization that have paid $30,000 for something like that. We gave it away for free. Matter of fact, we gave them a 3-night hotel stay for just showing up, right? So we gave them something, and people are paying $30,000 for what we did on a weekend for free in Orlando. It's a joke what people charge for day trading. All right, so now you guys are at the edge of your seat. You're like, spit it out, Hiram. What are the two things? And some of you guys are already like, I already know. What makes a successful day trader, hands down, bar none, you will not be a successful day trader if you don't do these two things. If you don't have proper money management and proper exit strategy. It's not some winning strategy that is just going to dominate and you're just going to win until the cows come home. It's just, it doesn't matter if you win 99% of your trades if one of them is all it takes to wipe you out, right? And you talk to most traders that have had their tails handed to them, that's what it was, is that one trade. I hate the GBP JPY. I don't like the Australian Canadian dollar. It took my account last time. No, it didn't. Your stupidity did. So let's not be stupid, right? It's all right. I mean, ignorance, whatever. Call it whatever you want. We can use nicer words, whatever. If you guys need a safe space, you're probably in the wrong room. At least we're not online, right? So we're okay. All right. Okay. I'm sure if I was a white guy, I probably wouldn't be able to say that. Sorry, guys. It sucks for you guys. Like, I'm brown. I'm in a wheelchair. I can get away with just about anything. Like, second to pregnant people. Pregnant women, they can get away with anything. Anything, right? I mean, you can't, a man, you can't, it doesn't matter, color, creed, it doesn't matter. You can't go into Babies R Us and piss in aisle 2, right? But a pregnant woman can, and everybody be like, oh dear, right? Let's help her, right? Everyone else, you get the cops call on you. All right, let's move on. Okay. Win rate does not equal more profit. If you have, let's say, well, we just use that example, a 90% win rate, right? And you take 10 trades. How many of those trades are successful? 9. Let's say you're taking 10 pips on each of those trades. So you have 90, right? 9 trades, 10 pips each. You won those. You have a 90% win rate. So now you have 90 pips. And your stop loss is 100 pips. Loser. You have one loser. How much is that loser worth? 100. Minus 90 is negative 10. So try going to the grocery store and pay for your groceries with a 90% win rate. Right? It doesn't work. You have to make profit with it. Right? Try going to the grocery store and spending, getting $1,000 worth of groceries and saying, well, I made 1,000 pips today. Right? But it was a 0.01 lot size, so you only made $100. So do you understand what I'm saying? All it is bragging rights for those other guys to sell you garbage. It's a lure. It's a shiny lure, and they want you to bite it. Right? So don't bring that here because it doesn't make any sense. It only makes sense if it makes dollars. Right? You add up all those cents and they turn into... Did you see what I did with the words there? Okay, good. All right. Good. A penny, what do they say? A penny saved, a penny earned makes sense? Yeah. All right. So let's not get caught up in that stuff, right? So when we talk about like 1, 2, 3, like Troy will come in here and he'll say, well, I do 1 pip, and people are like, what? Why do you even bother? There's swaps, there's so on and so forth, and he's like, but I did 7% today. You're like, what? You did what? You did 7%? Yeah, that's net, right? Did 7% today. On 1.5, 1.2 pip trades. It's all based on risk reward. It doesn't matter how much the movement is. Everyone was like, oh, if I could have just been on Bitcoin when it was way down here and went way up there. Well, look, first of all, the only time you ever hear about that stuff is the seldom unicorn white buffalo chance that it happens, right? And you know how many people that I know, and I'm sure you guys have heard the stories, but you guys probably know people that bought pizza for 30,000 Bitcoin back 10 years ago, right? Or they've got some flash drive in a storage unit that got repossessed that has 1,000 Bitcoin on it, right? It's gone. It's in a landfill somewhere. You're never going to get it back, right? But how many of those things come across your desk, your table every day? Thousands and thousands of them. So what do you just put $1 in each of them and hope? Because you could and still win none of them, by the way. right? You're better off just going and getting a lottery ticket and scratching yourself to death, right? That's what it is. Okay, or you do something that makes sense mathematically and scientifically. If you're looking to find like the secret formula that is just going to be the answer to all your woes, it doesn't exist. But there are ways to make it really simple. And I'm making a big deal about all this stuff because I'm going to show you guys something in just a little while that's going to blow your mind. But first we're going to learn the setup, because what's the first step? Identify, right? Okay, so let's identify. We're going to use a 60-minute chart. We're just going to start with the euro versus US dollar. All right, so this setup is called dirty pressure. How many of you guys are familiar with dirty pressure? Good, nice. All right, give yourselves a hand clap. All right, good. Some of you guys are like, yeah, you know. All right, okay. So dirty pressure is simple, and then there's a reason why I'm going to start with this one. What we're looking at in dirty pressure first is going to be the pressure indicator, which is the bottom indicator, this one down here. Now, for semantic purposes, we're just going to refer to where the green line is, okay? If green is on top, we're saying that green is on top of red. Right now, is it on top or on bottom of red? Bottom, okay, just so we understand what we're looking at. Now, these two pairs are linked. So the chart to your right is just expanded by 253 pixels. Because then we can see sometimes that line gets really close, right? It gets really, so like you can see it's really tight right there on the left. But on the right, it's more obvious what it's doing, which one's on top or bottom, okay? So we want to be able to tell which one's on top or bottom. Then we want to see a change in position. So when green changes its position and then is on top of red, okay, the next thing we want to be able to identify is major, minor pointed up. Okay, so green top, major, minor pointed up. Now, it doesn't matter if major and minor are overbought, oversold in the channel. They just have to, all four lines, green, red, gray, black, have to be pointed up. All right? Now, it doesn't matter which direction the pressure indicator is pointed. If green pops on top, it doesn't matter which direction it's pointed. If green pops on top, do we need to do a broken record? All right, you guys understand? Yeah. Okay, so what is most important in this setup? Direction or position? Position, okay? My hope is that you guys start looking at the pressure indicator for what it is, our fastest indicator. You didn't hear me wrong. Our pressure indicator is our absolute fastest indicator. You just got to learn how to use it correctly. Okay, so green pops on top. It doesn't matter which way it's pointed as long as green line is on top of red line. And then at that same candle, all four major and minor lines are pointed up. And then when green is on top and then it changes position and is on bottom, we just want major and minor to be pointed down, okay? And that's called dirty pressure. All right, so right now green's on bottom, so we're waiting for it to change positions and go where? Is it on top? Yeah. Good. What do we need for major and minor? Pointed up. Are they pointed up? They don't even need to be crossed, just pointed up. Okay, so for the sake of this, we're just going to use a, let's just use a 3-to-1, right? Who said that earlier? We'll use a 3-to-1, right? So we'll say 5 pip take profit, which means our stop loss will be, okay, so that's a 3-to-1. 3-to-1 is risk, reward. So 3 is 15, 1 is 5, right? So when we refer to risk to reward, the drawdown to profit, that's the order in which it goes, okay? A 1-to-3 would be a 5 pip stop loss and a 15 pip take profit. A 3-to-1 is stop loss risk to reward. Okay. All right, so that means that on this next candle, we want that to go up 5 before it goes down 15. And that went up 9.2. Draw was 9.9. So even if it went down first, it didn't go 15. It likely went up, took us out profitable, and then came back down. But regardless, even if it went down first, 10.7. 9.3, we would have still got our trade. Okay. All right, now green was on top. Now we want it to be on bottom, right? Okay, so right here, is it on top or bottom? Now it's on bottom. All right, now when green's on bottom, which way do we want major and minor pointed? But pressure's pointed up. All right, now we're talking the same language. I like you guys. You guys are cool. All right, so major and minor pointed down. Green's on bottom, so this is dirty pressure. Which direction do we trade it? Short. How many pips? 5. All right. And what's our stop loss? Okay. All right. Somebody raise your hand if you've never heard of dirty pressure before. Good. Stand up. All right. So we're going to finish this one real quick. Okay. All right. So did that one win? Yeah, that's fine. 10.4, 1.1. Okay. Now, let's review. Where is green pressure line? Okay. Where do we want it to be? For our next setup, we want it to change position, so it needs to be on top. And then when it's on top, what do we want major and minor to do?
Be going up.
Okay. So first step is identify, right? Okay. So here we go. So tell me when you see that. All right. And you guys don't help her. Okay. So first thing we're looking at is what?
I'm looking at pressure.
Good. That's where you should be looking. Okay.
Okay.
Okay, what do we have? Explain it.
Pressure's heading on top.
Good. Green's on top, right? And major, minor?
And they're heading up. Yeah, they're
Okay.
up.
So how many pips, which direction, how many pips, and what's our stop loss?
We want to take a 5 for 5 pips with a 15 pip stop loss.
Awesome. All right, let's go forward, see how you did. Actually, let's do this. I'm going to replay this chart, okay? Because now we know identify. That was easy, right?
Yeah.
It's easy to identify. It simplifies, but in back testing, you'll start noticing the nuances of the indicators by just practicing that, okay? But that's the first step. What was the first step? Identify. What's the next thing we need to know? When to place the trade, right? Okay. So now we're working on when to place the trade. Ash, can I get a silver coin?
You betcha.
Thanks. Tell me your name.
Cindy.
Cindy gets a silver coin.
Oh.
1 troy ounce, custom stamped. I love these things. Okay. This is how the candle started. When it started, majors are kind of sideways, minors are pointed down, green's not even on top in pressure, right? Now, Cindy, you said?
Yeah.
Okay. Tell me when you see the setup, okay? I'm going to speed this up. Let's go 100 times the speed. Come on. Thank you. Yeah. Okay, right there, right? Okay, good. So we have our setup. Now, when do we place this trade? Not now. We wait until it stays, all the parameters stay that way and the candle ends. Okay? So that's the when. So right now, if you look up here on TR, TR stands for time remaining, we have 12 minutes and 26 seconds. So if in 12 minutes and 26 seconds we still have green on top, major, minor all pointed up, then we're going to press that buy button and then set our stop loss and take profit, right? Okay, so let's get to the end of that. Let's press play here. And let's go. We got 8, 7, 6, 5, 4, 3, 2, 1. 14 seconds. Okay. So in 14 seconds, we have our MetaTrader up. We have it. What I used to do is I used to shrink it down just so I could see the buy and sell button. And I'd lay it right over so I could still see my green chart, but I could press my buy or sell button on MetaTrader 4, right? Now, later, when you get more proficient with the indicators, you don't necessarily have to wait for posts, or you may always wait for posts. But right now, and especially with pattern setups, you are waiting for the post, okay? So now you have your hand on the finger on the button. Now, I'm just going to draw a line where we would enter, okay? So 10, 9, 8, pause, 2, 1. Next candle, I press the buy button, right?
Yeah.
Okay. Now, do you know how to count pips?
Yeah.
So if I went from 125.38, what would my take profit be?
So we want 5 pips, right?
Correct.
13.
125.38. So what's my price?
125.
I'll show you an easy way to do it. Ready? Okay. So let's disregard the 8 at the end.
Okay.
So we have 1.20538. Let's take the 3 numbers to the left of the last number, which is 053. You see that? Oh, here, let me move this out of the way. See this 053?
Okay, yeah.
Okay, let's just use those 3 numbers all the time. All the time, okay? So that makes 53, right? What's 53 plus 5?
58.
I just take 20, and then I do 58, and then carry that last 8. And I have 5 pips. And then the same 15 pips. So do you have 53 and minus 15. What is your number?
43, 38.
Okay, so 123.8. Right?
Yeah.
There we go. So now I have a 5 pip take profit, 15 pip stop loss. It's easier instead of looking at the whole thing, right?
Yeah.
But even if you have to count 100 from there, you still have room. And if 9, so if it goes 5, 3, 8, and you're going 10 or 9 pips, right? Then you have 53 plus 9, and then, or if that's a 9, 3, 8, right? Then you have the, we're looking at those 3 numbers, right? 0, 5, 3. In that case, a whole number would still be 53. Sometimes it's 153, right? So 153, which would just be 158. So it's an easier way to calculate it, and that way it's not scrambling up in your brain. Because the first thing you'll do, don't do it more than once, is put in an inaccurate take profit, maybe too large or too little, and then you're supposed to come out profitable, and it's still running. You're like, what happened, right? Yeah, that's frustrating. That doesn't usually happen more than once. Okay, so now we've got our take profit and our stop loss. Okay, so we learned the identify, we learned when, the how in this case, we just said 15 and 5. 15 stop, 5 take, right? Okay. So we have all 3 elements for a trade strategy. Now the how is more complicated, obviously, because that entails back testing. And we'll go over that in just a moment, but let's see if you won. Okay, let's press play. Oops, wrong chart. Oh well. Okay. Here, play. Oh, it was playing, it was just slow. Okay, a little bit down, a little bit up. Come on. Money, right? Even with spread. Here you go. Congratulations. Give her a hand clap. All right. Thank you. Nice job. Okay.
Hiram,
Yes, sir.
just a question now. You said we had to wait until the candle posted.
Yes.
Now, is this on a 60-minute or does this matter? Or
That is a great question. It is on a 60-minute chart for that setup. Now, it doesn't mean that you can't use it on other setups. You just have to back test it, right? Corey, what are we going to call this thing? What did we say?
I'm
Speed.
thinking market replays the winner out of backtest, homework, R&D, speed quiz.
Market
Play
replay.
Market, but market replay seems a little on the strongest because we like to play. So it's
Yeah.
a really good word.
I like it. And we like the market, right?
And we like market.
And we like refunds, replay, redos. Yep. Okay, I like it. Sold. Market replay. No more backtest. It's called market replay now because you guys don't like that word backtest. Why? Tell us again, Corey, why we don't like backtest.
Well, because our mind filters things to protect us. The mind is just there to see how to save us from something bad. So we get all logical with it, and it can kind of create a negative experience for us. Our mind accepts things that are positive, present, and personal. So if you frame it in that way, your mind doesn't even need to filter it. It just goes, yeah, all right.
Yep. Okay. So then we're calling it market replay. I like it. All right. So what's interesting is that your brain has all these, and you're absolutely right, because it's one of the things that they teach you in sales is you don't ask for a social security number because you're always told, don't give out your social security number, right? But nobody tells you don't give out your social. Don't give out your date of birth, but nobody says don't give out your DOB or when were you born, right? Don't give out your credit card number. What's the 16 digits on your Visa? It's just ways because then people create barriers, right? It's not like you're trying to scam them. It's just you don't want to have those barriers. They want what you have. You just don't want them to be like, oh, this person's going to, scam me and they're going to take everything, right? I mean, you don't want to run into that. And if you say buzzwords, social security number, date of birth, credit card number, right? People, red flags, they're like, wait, I don't know why, but all of a sudden I'm having cold feet, right? So it's just semantics. But thank you, Corey. I appreciate that. So market replay. So when you market replay and collect this information, all right, Okay, so I wanted to point something out that's really cool. And that is that notice that obviously we didn't identify our setup until about 12 minutes before the top of the hour. Okay? And then then there was that time we had to wait for it, and then we executed. Now, I want to point out something that's really interesting because I think it's what confuses some people at times. There's a difference between post and start. The post is what's about to happen in 11 seconds. And the post and start happen simultaneously, right? So the post is when this candle ends, however it ends, right? And that's the start. So as soon as that new candle came out, that's the start. Look at the major and minor. Is that dirty pressure? No, right? But we didn't care if that was dirty pressure. We wanted the post, which is the way the previous candle ended, to be dirty pressure, not the start, which is how the current candle began. Okay? So that's important because that'll throw you off sometimes because you're like, well, it's gone now, right? Every time I'm about to execute, it's gone, it leaves, right? It's because our indicators are predictive. They're telling you what is going to happen a lot of times, right? And not just what is happening. Okay? So, and pressure indicator is invaluable for that, guys. Incredibly, incredibly valuable. Yes, sir?
Just real quick. Now, when it starts, you're supposed to see the color of the candle, the direction you're supposed to go. Or am I mixing that up with another one of these type of trades? It doesn't matter.
Doesn't matter.
Okay.
So what we're looking at is how this one ended. That one right there, how that ended. And that ended with green on top, major, minor pointed up.
So
And then, yep, as soon as that new candle comes out, we're in. Yep. Okay. Good. Good job.
Question?
Yes.
So I guess if you've tested it, even if it's barely over green on top,
Barely over? That's
over the red,
going to be based on your back testing.
but right there, look very, right there.
Yep. When you blow it up, it's not really barely over.
Right.
Right? But there are times, even when you blow it up, it's barely over.
I can blow it up, and mine's been looking like the other one. I'm going, I don't know.
Yeah, and sometimes that's all you got to do is you just take see these numbers down here where it shows the time. You just click and hold, and then stretch them out, and then make sure you put them back. The reason why is because the major and minor work on scale and pixel, and there's two scales laid over each other: the minor scale and the major scale. And if you stretch them out too far, or if you look at your charts like this, sometimes. So actually, this is a good example. Look at the major and minor right there, right? You see them? Look at them there. Majors are overbought in the channel. Overbought. And it's the same thing, right? But it's scaling in pixel. So I actually had Jeff, one of our members, reached out last night because he's like, this is happening. There's a way to and in the mastermind we do calibrations once a month, so we make sure that your charts are correct. But if you ever have a question about it, reach out to me. You don't have to be part of the mastermind. You can just call. Ashley asks me to help members with that stuff all the time. I don't mind. I want your guys' charts to be correct. And there's a correct setup, or rather pixel and scale for every computer because everyone's got different HDMI input, 4K, so on and so forth, right?
Hiram,
Yes.
is that a change that is done on the program itself, or is that each chart has to be updated?
When you figure out what it is for one chart, it's universal for all your chart books. On that machine, let's say that you have a laptop and sometimes you project to a television via HDMI. Then when it goes to HDMI, you notice that the charts change size, and so that will have a different scale than your laptop screen. So if you can imagine, these were invented over 20 years ago. Everybody had the same box monitor with the VGA input. There wasn't these, video graphics cards and HDMI and 4K and so on and so forth, right? So it was simple, but now it's become more complicated as we have more visually aesthetic screens and resolutions. Okay. Now here's how we figure out the how. The how is done by back testing. Now, when you backtest, you have to have science and math backing you. So how do we get to a scientific conclusion? Well, scientific conclusion has to be something that's scientifically viable, right? So if we just took, say, the last 6 months and we backtested something and we had 1,000 examples, well, that would be plenty of examples, right? But 6 months is hardly indicative of just about any market condition, right? So there's all these different market conditions. Sometimes it's biased in one direction. You know, like if you look at Euro USD 2014 to 15, April 2014 for about a year into 2015, all it did was fell and fell. It was at 1.40. That's $1.40 US per euro, right? Okay, so Euro US was at $1.40, and in less than a year, it was under $1.20, right? And then by middle of 15, it was all the way down to 104. 104 from 140. That's thousands of pips, guys. So another thing you don't want to buy into is the market doesn't always return. And even if it does, that's not a way to make profit. You don't just not use a stop loss. If somebody tells you don't use a stop loss, just write it out because you're making money on your swaps and stuff like that, that's stupid. Don't listen to them. And you can tell them Hiram said that, right? Just in case there is somebody stupid enough to say something that ignorant, that's stupid. It's stupid. You guys are here. If you're not here to make money, then that's not stupid. So does anybody think that that's not stupid? Right, because you're all here to make money, okay? So let's say that you got into a trade at 130 and it was a buy, right? You're like, there's no way. It's gone from 140. It's at 130. This is a major level. The RSI, the EMA, the stochastic, the major, whatever, right? You just convince yourself that now it's just going to buy like it's on sale, right? And it continues to go short, and you think, well, okay, it can't go any further than this. Okay, well, no, not much further than that, right? I mean, this was monumental. It never happened that aggressively ever, right? So a lot of people lost their shirts, needless to say. So you're in that sucker, and now you're waiting for it to return. And let's say you had the margin to cover it. Let's say you had a small enough lot size, okay? And you had the margin to cover. You had a large enough account and a small enough lot size to cover that. All right, and now here we are in 2019, which is 4 years later. And the closest we've gotten to that was in 2017, we got to 125, right? So still quite a bit ways away, right? 500 pips or so. And you just continue to write it out. And then we went to 103, which was lower than the initial 104. We almost paired with the US dollar, right? Okay, now you've been doing this for 4 years, and you've been making a whole bunch of nice, solid trades, but they don't outweigh this bad trade. And you want to withdraw some of that. You can't because you're in a trade. You have to close the trade. So can you really, and at some point, I mean, do you just continue on? What if it stays that way? How long are you going to wait before you can actually withdraw your money? And then consider all the swaps and all that other nonsense. There's no rule that says it has to return to that price. It may never return to that price. So why do that? That's just stupid, right? We're here to make money. And we want that return. We want it to be liquid so we can have the lifestyle. Right? We can have the things that money bring, not just a high win percentage or, I made 1,000 pips. Cool, it was worth $100. Good on you, buddy. Did that with a 2-pip scalp, right? What does it matter? Okay. So I did want to point that out, that the indicators, as soon as that new candle came out, it looked different, right? Okay. All right. And by the way, guys, if something's my opinion, I'll tell you it's my opinion. But if something's factual, I'm going to tell you that's fact. And not using a stop loss or an exit method is factually stupid. Right? What did I say? Well, number 1 rule? Proper money management. Second rule? Exit strategy. Proper exit strategy. Every professional day trader, all those millionaires that I met that don't use our system and took them 5 to 7 years and then 2 more years after that, so 9 years to become wealthy, all those guys, that's how they do it. And they don't have a choice. I mean, we have leniency. We can hit 70, 80%, 90% win rates. We have some leniency. Those guys have zero. They're 50 to 55% staunch. They know exactly what they're doing. They cut their losers. They don't even sweat it anymore. They're callous to it. They just know that's the cost of doing business. And they're millionaires with that garbage. And it's garbage. They spend all day doing that stuff. They're pulling their hair out. We're like, don't trade for more than 2 hours. You're going to get trader fatigue. You're going to get, all the psychological facet of going to mess you up, right? And they've just made it, after 5 to 7 years of doing that, they're just used to it. But that's about how long it takes. Google it. That's how long it takes to figure out how to day trade successfully on average out of the millions of traders in the world. And you know what their average win percentage is? 50 to 55%. Because everything that they're using has an A in it, right? ATR, average true range, right? EMA, exponential moving average. What is an average? 80%? 40%? It's 50%. Then you need your edge to give you that extra 5%. So they want to be within 50 to 55%. You guys could trade the classic on day one, be at 70%. 70%. You realize that people would die for the information that you guys have. I promise you, I've met them, right? It's so easy that we overcomplicate it. How long did it take you to figure out that setup? All right, I have guys that broke into 6 figures with just that, all by itself. Just that, right? Like nothing else. I get it. There's a lot of stuff. And for those of you guys that are working on something right now, don't jump ship and go to this, right? Stick to what you're doing. Master it. I'm not saying, hey, do my path. I don't care about that. What you need to know is money management and exit strategy, because whatever you're doing is going to work if you can figure out the risk-reward ratio, risk percentage, the probability of concurrent losers, all that stuff. What you're already doing is going to work. This is not the secret sauce. The dirty pressure is not the secret formula, right? Whatever other pattern I show you today is not. There's no secret formula that's just going to open up the floodgates. It's money management and exit strategy. It's whatever you're doing and implement those things. That's it. Master one thing. Let it get you rich. Figure out everything else afterward. Right? And there's tons to figure out. Tons. And we can go for years. Teach you guys stuff and break new barriers and it'd be awesome. But just do one thing first. Master one thing. Implement your money management exit strategy. It's going to get you rich. Okay? It's not like being the next American Idol. You don't have to be born with it. You don't have to be gifted in some way, shape, or fashion. Anybody can do this. Matter of fact, I think a 5th grader would do better than most of us. Right? Because they just take the instruction and they apply it. Right? Me, I'm full of testosterone. I'm like, I think I've got to figure it. Yeah, I get it, coach. But you know what? I think I noticed something you didn't notice. Right? No, not really. Right? But it isn't until I mess up or blow a demo account. And I'm like, okay, well, I'm not saying you were right, but you weren't wrong. You know? That's right. And that's why women generally are better traders, because you don't have the ego and the testosterone. And so you're just, look, man, let's face it. Women are an evolved species. Let's just get over ourselves. Okay. We lift the heavy things. Right? You guys just tend to get there faster than us. All right. And it's all right with me because I like women. So, okay. All right. So, now we know how to identify it. We know when to execute. We know, and the how is always going to be very personal. So you got to back test. Again, we're talking about science and math, right? Yeah, dang it. Market replay. Thank you. We've got a market replay, right? Figure out how it works for us specifically, right? Because the person sitting next to you may trade at different hours or different currency pairs. Right? Maybe a different time frame. So what is right for them may not be right for you. It's going to be different. So you got to figure out what it is for you. Now, to have a scientific and mathematical finding, we talked about scientific, you have to account for every market condition. January 2015 to current to 2018 accounted for just about every market condition that we've seen.
What was those dates again?
January, it's called the proving ground. So TPG on these stands for the proving ground. Mastermind is the next step, but the proving ground is a measurement of time. January 1 of 2015 to December, the last trade day in December 2018. That's what we call the proving ground. In that time, we've seen just about every market condition that can occur in the Forex market occur. So if we backtest the setup and we can prove it through that with a risk-to-reward ratio that makes profit, then it stood the test of the proving ground, right? And then you can execute it in your account. Generally, it takes about, for most people, anywhere from 6 weeks to 6 months to backtest just one setup on one currency pair on one time frame. So that's quite a bit of time, right? It's about 40 hours. But you think 40 hours, why do that 40 hours in a week? Well, for a living, right? I mean, 40 hours for those honeydews, it's probably taking you a year and a half, right? It's your New Year's resolution this year for the 3rd year in a row, right? And it's this 40-hour, it's a 40-hour deck in the backyard, right? Now already you got to replace the wood because it's rotted from 2 years ago. So 40 hours is a lot to ask sometimes, but if you dedicate to it, you can get there. Okay, so you've got a back test January 20. That's going to give you science, and it's going to give you the law of large numbers because you're going to have enough examples and in just about any market condition to justify your finding. The other part is math, right? There are ratios that are mathematically profitable and plenty of others that are not. That's just the way it is. I didn't make up the rule. It's just math, right? So, for example, if we won 7 out of 10 trades and we're using a 3-to-1 ratio, so that means, let's say we're using a 10 pip take profit, then our stop loss is what? 30. Okay. So we have 7 winning trades for 10 pips, and we win those. So we have 70 pips. We have 3 losers times what? Which is 90. Which number is bigger? So we know we can't use a 3-to-1 with a 70% win rate. So that it goes back to the first question. How do you figure out your win rate? Market replay. Thank you. Market replay and gather that information and figure it out, right? Okay. Some of you guys are already not like it. This guy is like, I hate that. I don't like that. I bet your toes are crossed, man. No, I'm just playing with you. It's cold in here. I get it. I'm just playing. No, it sucks. It sucks. It does. Well, I mean, some of us are just sick individuals. I love backtesting. I love backtesting. That's the truth. Okay, so let's continue with this setup. Okay, so let's continue with this. Let's look for some more setups. All right. So shout them out when you guys see them. Who wants to take a turn? All right. Come on, stand up. Let's get him a mic, Ashley.
Earn him a coin. Has everyone seen our coins?
Our coins. Pass these around.
Sure,
Pass one of these
I'll
around.
pass some
Not yours.
coins
Don't
around.
pass. It might not come back.
It might not come back. Who was it? Who was it, John?
Such disrespect for the coin. Thank you, sir. Yes. Okay. Pass that around, guys. Okay. So they're custom stamps. It's a 1 troy ounce of silver, which is about $18, but the stamp actually costs like $20. So it's about $38. I'm serious. It costs about $38 for that. But it's our culture, right? And it's a big deal. For a while, it caught this buzz, and I think we just kind of let it go. But people really wanted them because it represented our culture. And for some people, I know some people, they still carry theirs. You know, and they talk about how this means something to me. This is a pivotal moment in my life, right? This was where my life changed. And this is, you know, people move to America and they fly the American flag high because they're like, this means something to me. Well, it's like that coin, right? It's not about its monetary value. It's significant. It signifies something for a lot of people. And it could be different things, but, you know, affiliated with the organization in day trading. Okay.
In the Marine Corps, we call it the challenge coin. You don't carry one, you have to pay next round.
Ah, nice. All the greenies, right? I like that. Careful. Once a Marine, always a Marine.
Hey, Marines belong to the Navy. Ask them who writes their paychecks.
Department of the Navy, they're always taxing them.
Man, I know so many jokes for Navy people. All right. None of them appropriate enough to speak. Okay. You ready?
Sure.
Okay. Don't help him.
Are we doing dirty pressure?
Yep. So you tell me when you see it.
Right there.
What do you got? Explain it.
Red crossing over, majors and minors.
Whoa, green.
Red crossing on top.
So when you say, you're right, yes. But the reason why it's semantics. Because when you say top, which direction do you think? Up. Okay, so if you say red on top, but majors and minors are pointed down, when it's emotional and the psychological facet of trading kicks in, your brain gets scrambled, right? So we want to begin with the end in mind. So we're going to say where green is, because when we say green is on
Gotcha,
bottom,
gotcha.
when we think bottom, which direction do we think?
Down.
Down. So which way do we want major minor to point?
Down.
Down.
Gotcha.
Right.
Okay.
Okay. So
Okay.
go ahead.
So green crossed down, crossed under, and majors and minors are pointing down.
Perfect. Which direction are we trading for how many pips?
So we're going to go short. So we're going to sell for 5 pips and a stop loss of 15.
Awesome. All right, let's see how we did. And we're going to wait for the post. The post happens. Next candle comes out. We sell. Looks like it went both directions. Let's count it. 4.2 pips up and about 14.7 down. Did we win?
Oh, yeah.
We won. All right, awesome. Good job. That coin that's circulating, that goes to the gentleman. Tell me your name, sir.
Thank you. I'm John. Summers.
John, good job. John, thank you.
Thanks, Hiram.
All right. Okay. Yes, sir.
Did you say 4.7 down?
14.
Oh, 14, okay.
14.7.
I misunderstood.
Yeah. So when if you guys ever use a chart calculator tool, you see it says 147. Can you guys read that? It's kind of small. 147 is 147 micro pips, which is 14.7 regular pips.
I couldn't see it.
Yeah, it's kind of, yeah.
4.
Oh, yes. I think up, it went 4.2 up. That's probably what you heard. It's the fast talking. Sorry, man. I always say I have accents. Gets me away with it. All right. Okay, so who's up? I still got 3 coins. All right. Come on up, sir. David, right? All right. Oh, 3's good. I'm just kidding, Ash. You should bring me the whole box. No. Okay, so are you ready?
Yes.
All right.
Green's on top.
Good. Green's on top.
It's not
Why?
because the majors minors are down.
Anybody else catch that? Awesome. Green's on top, but major and minor were not pointed up, right? Okay, so now not only can we identify it, we can also identify when it's not there and it may look as though it should be, right? Good. So we don't have, now a lot of reasons why that would sell, obviously. Okay, we're not doing that. We're doing just dirty pressure. Okay. All right. Okay, so tell me when you see the next one.
Red on top,
What?
green on bottom,
Good. Okay.
and the majors minors are pointing down. Majors are down. Minors are up.
So is this dirty pressure?
No.
No. Good. Good catch. Okay. So you got, yeah, good catch. All right. Whoops. Yeah.
Green on bottom.
Sorry, I went back to that one.
Oh, okay.
Majors are pointed down, minors are pointed up. Green was on bottom, but this is not dirty pressure. So let's keep on looking.
Green on top. Majors
Good.
and minors are up.
Good. Which direction? How many pips?
We'll do a buy at 5 up, 5 take profit, 15 stop loss.
Perfect. All right. How do we do? Let's see. That went 12.1. Drawdown was 2.7. You won. Nice job, sir. There you go. Good job. Thank you, David. All right, so it's simple, right? And that's good because I'm glad we had some. And look, we've seen winners. That's cool. They lose. You have to don't expect that they're just going to win. Matter of fact, with that ratio, it's like 76%. So it's not really very appealing if you use the 15 and 5. So I would have expected to see a loser at least by now, because 76% with a 3-to-1 ratio is kind of pushing it. I mean, it's profitable, but just barely. Yes, sir.
What would you use as a stop loss?
It's based on back testing. So, admittedly, I don't trade my patterns. These are for you guys, right? Because it can break down something that's complicated that we've learned over years and condense it into something simple, like sight words. So I always say indicators are like a language, right? And when you learn a language, you learn, for example, when kids are learning how to read, they don't know that W makes the W sound, but they know that W-A-Y when they see it is way, right? Because it's a sight word. They don't know how to sound it out. They just know that the shapes that makes says way. And then later they learn how to pronounce it, right? So patterns are like sight words. And then later you learn other facets of the indicators that are illogical and they're a lot more advanced. And I'll see if I can cover some of those today.
I thought these were 90% approved, or 90% not.
So if you backed, okay, so if I backed, let's say the flat top, for example. If I back test the flat top for a 15 and 3, it's over 90%. So are you going to take the flat top every single time it occurs? So then you're not going to be at 90%. So it's irrelevant what it tests at 100% of the time, because you're not going to take the trade 100% of the time. And in order to keep that ratio, in order to keep that percentage, you have to take every single one of them. So the likelihood of you getting one successful at random is really, really good. But what if it just so happens to be that the 10% of the time that you trade it sucks? Right? Or the time that you trade is the 10% of the time that it just doesn't do well, right? So the way you figure that out is by back testing. But more importantly, back testing is so you can understand the nuance of the indicator. So that at some point you can start understanding the language more aggressively. Sometimes the indicators are pointed up and it's telling us to sell. Or they're pointed down and it's telling us to buy. Or it's not really pointed in any direction, it's telling us to do something. It doesn't make sense logically. One of the other analogies we always use is, like in English, the language itself doesn't always make sense. So you park in a driveway and you drive in a parkway, right? It doesn't make sense logically. But it doesn't matter if it makes sense logically, because you understand what I'm saying and I understand what you're saying when we use those words, right? All that matters is that we communicate. It doesn't matter if the words make sense logically, like cargo and shipment. Shipment comes in a car and cargo comes in a ship. It doesn't make sense logically. It doesn't have to, as long as you know what is being conveyed. So it's the same thing with the indicators. It doesn't, just because they point up doesn't mean it's time to buy. Sometimes it's time to sell, and that's what it's telling you. And the important part is that you don't have to get to that level of mastery to get rich using these indicators. Whatever rich is for you. If it's 6 figures, great. If that's rich for you, that's awesome. If it's 7 figures, awesome. You can get those things. You can get those things. You just have to be disciplined to your craft, right? All right. So let's do a different setup. I want to show you guys something really quickly.
I had a quick question.
Yeah.
Do the pressure indicators have to be crossing, or can they be separated at the same signal? Apply.
So change in position in that particular setup, a change in position is just when it goes from being beneath to above or above to beneath.
But not necessarily cross.
Well, they will be crossed.
Because it is, okay.
Yeah, the pressure indicator. Major and minor don't necessarily have to have just crossed or,
So it's not just on top or bottom if they're separated. It's the actual change.
It's just a change in position. Okay. So for Mastermind members, we have flashcards. Dirty Pressure is one of them. Here's flat top. Click on them. Tells you line by line what it's supposed to be doing. That's not what I wanted to show you. So here, after Tuesday, let's go to Dirty Pressure data. After Tuesday, I already have the information. I just haven't put it on the site yet. This is back tested January 2015 to September 2019. Hour by hour for buy, hour by hour for sell, and what the most optimal stop loss and take profit and the percentage of win is for each hour in a 24-hour period back tested from January 2015 to September 2019, which is just 2 months ago. The data that I'm going to post on Tuesday after the mastermind is going to be to November 2019 because I just had it updated and 5 other currency pairs added to that. That means that you would have 6 different currency pairs outputting Dirty Pressure, which happens about 15 times a day, and exactly how to trade them with percentage and stop loss and take profit.
Where will this be held at in the mastermind so I'll know where to look?
Under resources, under the resources tab. This is what it looks like when someone like me sells out, unfortunately. I never thought I would get to the point where I would just give you that information. Never. Because that which is obtained too cheaply is esteemed too lightly. It pains me to give you this information. It does. Because I think I'm one step out the door. I don't know how much longer I can. Some days I'm like, I do. No, that's not why, because if I loved you, I wouldn't do it. If I really loved you, I wouldn't do it. Back testing is a dying art. When I'm the way mastermind members back test, when I'm no longer in the spotlight, so to speak, it'll be a dying art. Eventually it'll go away and no one will ever do it that way again.
What will they do?
Market replay.
Yeah, they won't even do that. Yeah, she got it. Nailed it.
They're going to have all the mastermind charts already pre-laid out.
It's all going to be there.
Yeah.
It's all going to be there. So you'll have it. We were just joking the other night. We're like, it's like we always say it's like leading a horse to water. Waiting for his mouth to be open, splashing the water in his mouth, but you still have to drink, right? Now it's like we're plugging your mouth and nose, jabbing you in the throat. It's literally your whole trade plan already set out for you. How many of you guys in a 24-hour period can take 10 minutes out of your day to make 2 trades? Okay, so you already know what the pattern is. It's called dirty pressure, right? Now, you don't even have to rely on yourself to identify it in its entirety, because 5 minutes before the top of the hour, I just send you a notification. And it says dirty pressure on this currency pair. Then you go to that currency pair, you say, yeah, it's still there. The lines are still pointed up. Green's still on top, right? Okay, so it's still there. Now you're just counting down 5 minutes. And then at the end of the 5 minutes, you know which button to push, whether it's buy or sell, and you know what your stop loss and take profit should be. And with your percentage of win, you know how much, if you are a part of the mastermind, you know what lot size you should use, what a percentage of your account you should risk based on the win percentage. So you know everything from start to finish and how to execute that trade. If you can do that twice a day, even with a 70% win rate, you're still looking at a double up every 4 months in a private in a personal account at 70% every 4. Do the math. Yes, sir.
So in essence, you're saying there is no magic formula.
There's still not a magic formula.
Yeah, you've just given it to all of us.
You're going to choke on it. It's that which is obtained too cheaply is esteemed too lightly.
You're right.
It came too easy to you guys. You're not going to appreciate it. You're going to squander it. It's like hitting the lottery. I'm giving you the lottery ticket. It's not that I hate you, but that's how it feels right now. That doesn't feel very nice. I've put blood, sweat, and tears into this program, but I don't think I want to fight the fight anymore. So you guys aren't 10% of you guys back test. It's hard. I get it. You don't have 40 hours. Yes.
Teacher for 32 years. It's the same problem everywhere.
You know my pain.
We are inherently lazy.
Yep. But that's all right. I want you guys to be successful, so I'm going to give it to you. But I promise you, the real value in mastermind, the real value in what we're talking about today is the foundational principles of being a successful day trader, doing the work, proper money management, proper exit strategy, market replay. I got to train the brain, right? Market replay. Some of us are just, we like to market replay. It's fun for us. I mean, if you guys saw my trading regimen, you could just be like, yawn, that's boring, dude. It is not sexy. It's not exciting. I'm like, I already know everything I'm looking for, and usually I know exactly when to find it. So I go into the market, okay, I see what I need to see, press the button, within 15 to 30 seconds I'm out of my trade, and I'm done for the day. Then what? I'm 37. I can't just sit at home. I tried. It drove me nuts. Right? So here I am with you guys. And I like this. It makes me feel good. And then I like to be able to get back to you guys. But it's a fight. It's a fight. And it's frustrating. It takes a lot out of you when you know the answers and you give people the answers and they don't apply them. Dr. Zed? So...
That is probably the ultimate frustration.
That would pay.
Well,
That's okay. Fortunately, my pay is real good. A matter of fact, I'm doing this for free. I don't get paid to be here with you guys. I never, if you guys ever see me up here like this for Wednesday nights or anything, I don't get paid anything for this. I love this. I love it. And every once in a while, I'll get somebody to step up and do some massive amounts of back testing and come up with their own theories and formulas and stuff. And just, matter of fact, I mean, we've put out Jared Johnson. Raise your hand. This guy's a stud, by the way. If you guys don't know this guy, the guys like Jared right here. Jared specifically, that's the future of day trading. I'm old dog. I'm going to be put out to pasture soon. That's the future. I'm telling you right now. Later, it's going to be Jared Johnson. That's going to be the name. That's going to be the banner name, not the names that you guys know right now. When I was first starting, there were names, and now those names are like almost a joke. And now there are names, and later it'll be Jared. It'll be guys like that. So I'm excited for these guys because they know the work. They know the blood, sweat, and tears. But we've put in all these hours, all these thousands and thousands of hours. We should be able to make people like Jared, right, where they're going to be better than we are, right? Because here's the shortcut. You didn't have to figure all this out. We figured it out for you. We put it in a nice, neat package. We delivered it to you. Now you just got to execute it. And then you execute it. And so now you're starting from thousands of hours ahead of where we started. You should be able to run faster and further. You should be able to be more successful than we are. If you're not, what the hell are we doing here? What am I doing here if you can't be more successful than I am? If that's as good as it gets, that's sad. That's really sad. And eventually Jared will hand off the baton to the next, and it'll always just evolve and continue to evolve. And that's what we're starting to see more and more of. I'll tell you right now, this isn't going to help. It may not hurt. Put some coin in your pocket. It's not going to make you a professional day trader. It's going to make you an entry, what do they call it? A data entry person. You're just going to see it, push the button, set your stop loss, take profit, put some money in your pocket. That's good. If that's enough for you, that's okay. That's good. When it's not enough for you, then we'll talk. All right, enough of that. Let's go back to some stuff here. It's really actually because I ran out of stuff to talk about, so I was like, let's just vamp for a second. Right? No. She's like, yeah, right. You ran out of stuff, Hiram. All right, let's do this. Yes, we still got time. Okay. Now we're going to learn about flat top. All right, that's another one I have data on. It's a different type of data because it just tells you one set of stop loss and take profit. It's pretty incredible. I'll show you guys that data here in just a moment as well because it's cool how you can use it. And that was more of a challenge type data set. So I actually like that one a little better than this one, especially because it's a 5-to-1 ratio, which sucks, but it also performs really well. Okay. So flat top is on the thick orange in the TNT and the position of major and minor, either overbought or oversold. Now, when the thick orange is flat and has a value of 0 on top, that is a flat top. When it's flat and has a value of negative 100 on the bottom, that is also a flat top. Now, you can call it a flat bottom, call it whatever you want, but the alert would say flat top, right? Okay. So, well, in combination with major minor. So let's go over setup first.
Are you still on a 60-minute chart doing this? I mean, I can see you are right now. But.
Yes, good question. Thank you. To clarify, all the setups, all the patterns are going to be on a 60-minute chart, except for the duckbill. The duckbill is going to be on a one-day chart, but that's like a 50 pip trade on a 1-to-1. That performs at about 77, 78%. At a 1-to-1 is pretty killer for a 50 pip, but there's also a 50 pip draw on that, right? So it's 50 pip draw or 50 pip take profit. So your lot size isn't jacked up, but it's pretty healthy. The other thing is they don't happen every week, so you might go a week or two without having one. But that's the only one that's going to be outside of a 1 day, or rather a 60-minute chart. That being said, you can backtest any time frame you'd like. Right? It doesn't mean that it only works on the 60-minute. You can try it on any time frame you'd like. This is just how we use it for the alerts. Now, why the 60-minute? Anybody know why we use the 60-minute? Because it is the anchor in the Forex market. It is the most commonly used time frame in the Forex market. And why we use the post is because 90% of traders in the world wait for the post for their setups. They use garbage like price action and candlestick patterns and so on and so forth. But in order to get those, the candle needs to end. And then once the candle ends, they get their read and then they execute. So it's based on post. So if we're looking at the dichotomy between major and minor and how major are going to take advantage of the minor or play with minor, however it may be, far be it for us to not wait for the post. Majors are waiting for the post, not because they're waiting for it, but because they know that the minors are waiting for it because that's what they taught them to do, right? So we were talking about earlier, and then I'll get to flat top. We were talking about the difference between a million, a billion, and a trillion. And actually, you nailed all three of them, didn't you? So I'm gonna pose a question to the rest of you guys here. If you had 1 million seconds, how much is that in days or weeks, or what would you think? 1 million seconds. So Phil, if you guys have ever sat into Phil Farmer's sessions.
Who's a farmie? Raise your hand proud.
Yep. 1 million seconds is about how long? It's about 11 days. What about 1 billion seconds? It's about 32 years. 11 days to 32 years just from 1 million to 1 billion. What about 1 trillion? Yep. 31,709 roughly. There's not even, if you spent $1 trillion in a year, you would have to spend $1.09 million a minute. It's impossible to even spend $1 trillion. So imagine if 4 trillion.
Yeah.
Is that? Unless you're the government, right? I know. Seriously, how do they do it? Holy cow!
Lots of waste.
Oh man, I bet they're like, oh, we got this. We'll get creative with this, right? Yep. Donation. Oh, sorry, I sneezed on myself. Anyway, but so trillion, right? So you have institutions, which there's only 5 of them, right? And they have trillions. Okay. The Forex market is $4 trillion a day market. Euro US is 1/3 of that alone, right? So that's 31,000 times 4, right? 32,000 times. Okay, so just to give you the magnitude of what we're talking about here. Now, it's a zero-sum market, even for the majors. The majors don't just get to put in trades, by the way. They have to have counter trades, just like the rest of us do. And no, they don't know where your trades are. They have algorithms to try to figure it out, right? But they don't know where your trades are. They don't know how many people are buying versus how many people are selling. Nobody knows that. Okay, so how is it then that they can get enough people to take a counter position, because it's going to take millions of them, to do something counter so that the majors can put in a big move? How do they do that? Do they just guess? They flip a coin? They hope? Misdirection, right? Education. They teach you how to trade. You go to YouTube, right? You talk to Thinkorswim, Fidelity, T. Rowe Price. You talk to NinjaTrader, eTrader, right? They teach you who do you think those are owned by? Right? They're not owned by mom and pops. They're owned by institutions. I'm not talking about Wells Fargo. I'm talking about the company that owns Wells Fargo, right? The bank that owns Wells Fargo. UBS, Credit Suisse, the big institutional banks, trillions of dollars, right? Centralized banks. That's who we're playing against in the market, majors versus minors. There's millions of us. There's a small amount of them. So they can take a whole bunch of lots and put them in the market to go one direction. The market moves in that direction. But that means that they have to have a whole bunch of lots going the opposite direction. They're not just guessing and throwing it, okay, what about this much? All right, back it off a little bit. All right, how about this much? No, they know exactly how much they can put in, right? And they do it all the time. Why? Because they've taught 90% of the traders out there how to trade. And they trusted them because they're reputable names, right? I mean, this is T. Rowe Price. Of course I'm going to trust them. They handle my 401k. How's that going for you? 2008, 2016, right? Awesome. Good job. Right? So when you look at that dichotomy, you got to realize that what we're looking at with our major minor indicator and how they work is giving us real-time information. It's not just an autoregressive model and giving us this stochastic evaluation, a best guess at average, right, as to what's going to happen. It's much more accurate than that. But it's simpler, right? It's just taking one thing, mastering it, and running with it. Okay, so let's look at the flat top. So we want negative 100, but we want the line to also be flat.
How many of these will happen in a day, a week?
In a day? A couple a day. Maybe like 5 4 or 5 on 6 different currency pairs, sometimes more. Sometimes it's like double or triple that. I'd say on average it's going to be like 5 to 7 a day on 6 different currency pairs.
So zeros at the top and negative 100s at the bottom, or is it?
Correct. So you'll notice here the thick orange is flat and it's at 0.000000. Okay? This is not a flat top because major and minor have to be overbought when this says zeros and it's flat. If it's on bottom, it's negative 100 and major and minor have to be oversold. Okay? So this looks like a flat top, but it's not because we're not overbought. Nope. Almost, right? Partially, but no cigar. And that's probably not going to last beyond that. Oh, look at that. Winner, winner. I didn't really think it was going to go that many. Okay. So now we have 0, we're flat on top, and major minor overbought. Now, after you guys start back testing, you realize that there's more dynamic ways to look at this and some that work out better than others. But right now, let's just take it at face value. Just the exact rules is what we're going to implement for the purpose of this demonstration. Yes, sir?
So anything above that thick blue is considered overbought?
That's correct. Anything above the thick blue right here. So green, red, gray, black, all of them are above the blue. And the thick orange line is flat on top and 0. So this is a flat top. We were just talking about flat top a moment ago. We've used the 5-to-1 and hit 90%. And you can go back and validate that, verify that. Some people are doing obviously more than that. They're doing even 10, 15, 20. It just depends on your back testing, basically. Obviously, they don't always win, but they're pretty consistent. So this being a flat top, the next candle, and we call this illogical setup because generally major minor are pointed up, we would expect at least 3 pips to the short side. We'd expect a short trade. Now this is something you want to back test, just like with dirty pressure. Well, I mean, you got data on it now, but.
Did you mean market replay?
Yes, I did mean market replay. Thank you.
Do you remember a couple months ago, Hiram, I was saying I hadn't lost one of these since I started?
Oh, yeah.
A month ago yesterday, I lost my first.
Finally. How long have you been trading the flat top?
About 3 years.
Holy cow. Oh, my gosh.
And I made a point of telling all my students I lost this one.
Because it gives them perspective. Because they're like, oh, bet the farm. By the way, never bet the farm, right? Why do we never bet the farm? That's right. It only takes one time to lose what? The farm. Don't bet the farm. You're going to lose at some point. And if you bet the farm, at some point you're going to lose the farm. I was talking to a guy when we were out in Orlando, and he's like, but I think I got it figured out, and I keep on going to these sessions because I'm trying to connect the dots. And he says, because I've made $62,000 in one day in the market. And then, the next day I give it back. And it's like, okay, you haven't figured it out. You haven't. What you use, the same strategy that you used to make $62,000, you had too much at risk, right? You bet the farm, and it worked until it didn't, right? So he just he couldn't get it. He's like, I know how it is to be successful in the market. No, you don't. Just because you made $62,000, you should have quit. Then you would have been successful. But you keep on going, and it bites you. And of course, they get that drug, right? That dopamine, and it becomes an addiction. And then it's gambling, right? And they're like, they want that high. They rewarded themselves for pissing on the carpet, and they think they did something correct, and so they can't break away from that and be taught the correct way. And that's why we have those conversations with them. I can't do anything with you. If you're not willing to forget everything you know, I can't teach you. And if I can't teach you, keep your money. It's not going to work. All right. So let's look for one that is oversold. Okay, so negative 100, but what are we missing?
Flat.
And? Major, minor, oversold. Good. Yes, sir.
Are you looking for on the thick orange to drop off of the 0 or 100 just to change, or do you want to see so many points? Isn't it like 10 points or 8 points?
So what are the rules? Thick orange is what?
It's flat.
Flat and a value of what?
0.
Negative 100. And then where are the major, minor? Overbought or oversold. What else? That's it, right? Okay. That's it. All right. So it's funny because usually that conversation is had with dirty pressure because they're like, wait, don't major minor have to be oversold and then pointed up? No, it doesn't matter as long as they're pointed up. Okay, wait, but doesn't pressure have to be pointed up? Or, no, as long as the green is not. Like, that's usually the conversation we have, so I left it kind of open with this one because I knew it would come.
So this isn't the thick orange then, this is the flat top.
This is where they got the thick orange. Yeah, the thick orange performs at like, it struggles at like 60-something% when you backtest it 100%. I mean, you can find times that work really well, but it doesn't perform as well as the flat top, not by far and away. Yes, sir?
Yes, now when we were doing the dirty pressure, it was 3-to-1, but we were using 5 pips. How many pips do we do this on a 5 pip?
It's based on market replay. Yep. So we just use that. So the only reason I use those parameters is because somebody had brought up a 3-to-1. But also I wanted to explain the 3 steps, which was identify your setup, when to place it, and how. Right? Plus we have data for that, so you're not going to use the 3-to-1. If I give you something right now for this, you'll use it, and that's not right. It's not correct. What will be correct is based on your market replay. I got it that time. It came out even natural. Did you see that? We're getting there. All right. Takes me a few times. Okay. So no flat. So this is just one currency pair. Generally, we've got them on 6, running on 6 different. So that, well, why don't we? I've got the mastermind chart up. Holy cow, Hiram. Welcome to the conversation. Okay. Here we go. Okay, we got 6 different. All right, everybody keep an eye. Keep your eyes peeled. Actually, who's up? There we go, right here. And then you'll go next. All right. We got to stand up, man.
Oh, okay.
Make your presence known. You want a microphone?
No.
All right.
I've got a voice.
There you go. Well, now you got a mic. All right.
Okay.
So help them out, guys. If you guys.
Which pair? Just any?
Yeah, we're gonna look at all 6.
Do we want the Euro US first? That's already there.
Yeah, we can. Well, is it?
Oh, it's not. Oh,
it's
can't see
small.
that.
Yeah,
Okay.
if you can't see it, the value is not 0
Okay.
on the EU, on the Euro USD. Okay. So easiest way to identify a flat top first is obviously just to look for the thick orange being flat, and then look at the value, and then look at major minor. Okay. So that is flat, but it's not at the value, right? Okay. All right. I'll let you go. And let me know if I'm going too fast.
No, go ahead. There's a bottom there on the third one.
That's
Is it
GBP
minus
USD?
100, yes.
Good. Okay. So explain to me what you're saying.
The flat bottom or flat
Flat
top
top,
at
yeah.
the minus 100. And oversold, or yes, oversold both pairs.
Major minor oversold. Good. So this is in fact a flat top. So negative 100, flat, major minor oversold. Now when we talked about the 90%, by the way, that was on the euro versus US dollar. I realized I didn't clarify that earlier. But that's if you took all the trades, which isn't going to be relevant unless you actually did take every single trade every single time, which means you'd have to be up 24 hours. Okay, so which direction are we looking to trade this?
As a buy.
Okay, good. All right. And then how do we determine our stop loss and take profit?
Determines market research.
Replay.
Market
Good.
replay.
Market replay. All right. Awesome. All right. Good job. Here's your coin. Give him a hand, guys. Nice. Thank you.
Fabulous. Thank you.
Yes, sir. All right, sir. You ready? Okay. You're up.
I'll have to come up here. My eyesight's not too.
Yeah. By all means, go right ahead. Take this mic right here.
So how far did that one go?
Let's measure it. 2.2, 3.1. Let's go forward. There's a little extra there. 3.1 down. 3.9. Sure, it took a while. Kind of played back and forth. So, would we have covered 3? Yeah, probably would have covered 3. And depending on what time it is, you're back testing. You could have maybe you're going for 15 right there, and it's going to lose. You know, who knows, right? But it's all going to be based on back testing. Okay. So now let's look at, okay, you ready?
I'm ready.
All right. Tell me if I move the clicker too fast for you.
You're fine so far.
Do you want me to go back to that one? I heard you guys.
Okay, up there at the USJPY, we have it as a 0, and the majors and minors are all overbought.
Awesome.
And so we would go for a sell.
Excellent. Good job. Thank you. Give them a hand, guys. Nice job. Thank you.
So Hiram, does it matter if it's not 0 both times when it flattens out?
It'll only be flat if the previous value is 0. So imagine that line is either moving up, down, or sideways. In order for it to move sideways, then it has to have the exact same value as the previous candle. So if I go back on this candle right here, it's going to be, usually it's 0. Wow. Dr. Zed, I got to calibrate your charts.
Okay. Show me how to do that, because I don't know.
I will, yeah. 0, flat. Usually it's because the previous was 0. And then it'll be flat and 0. Okay, and then we'd be looking for a short. I'm sure you guys want me to measure that. That went 5.5 up, 2.5 down, and there's the finisher 14.1. So if you were going for anything within that range. So all we're doing basically is we're using what we know of the market and our indicators against itself, right? We're waiting for it to be maxed out, and two indicators telling us that it's maxed out to the buy side, so we got to have some give back. And then we just quantify the give back. How much is that for the times that we normally trade, right? Does it mean that there's going to be a red candle all the time? No. But does it matter if you got out of your trade? You can get out of your trade, and then it can go 1,000 pips up for all you care. You're profitable. You're out. It doesn't matter if it goes the other direction. Now, obviously, if it doesn't get you out of your trade first, have a stop loss, right? What's that second rule? Exit strategy. Thank you. Okay. All right. So let's take this example really quickly, and let's say that we're going to take this trade. Now, let's say that we win this trade. I'll give you guys an easy one. Let's say that we win this trade 80% of the time. Okay? So 80% of the time, does anybody know what risk to reward ratio you could use maximum at 80% win? 3 what? 3-to-1. That's the max, right? You can't use a 4-to-1. You can use a 2-to-1, a 1-to-1, a 1-to-2, so on and so forth. You can't use more than a 3-to-1. 4-to-1, 5-to-1, don't do it. Okay, so we're using a 3-to-1. So let's say we were going to go for 5 pips on this trade. What would our stop loss be? 15. Okay. Let's say we have a $10,000 account. All right, and we're doing 80%. At 80%, you can risk anywhere from, let's say, 2 to 3% of your account. And you have a $10,000 account. So let's say we're just going to do 2% because we're already at a 3-to-1 at 80%. So let's just keep it on the low end. 2% of my account, and I have a $10,000 account. What's 2% of 10,000? 200 bucks. All right. I have a 15 pip. You might need a calculator for this, and that's okay. I do it all the time. You might, at 15 pips, what's my lot size that would equal $200 at 15 pips? So lot size of 2.2, right? Is that right?
Yes.
Okay. $22 of 2.25?
Yes.
Okay. 2.25 is my lot size for that trade on a $10,000 account. Not a $100,000 account, by the way, guys. Just a $10,000 account. So I was having a conversation with somebody at about a 0.01 lot size, and it's like, well, what do you trade it at 100,000? They're like, well, somewhere around a 0.5. Now we're at 10,000, and we're doing a 2.25 lot, right? If you're at a 0.01 lot size, and now you're moving up to a 2.25 lot, that's going to be a psychological meltdown for you. You're doing yourself no favors by not knowing what these numbers are. You're not doing anything except for not blowing up your account. But where in that equation equals profit, return on investment, supplementing income, replacing income, building wealth? Where does a 0.01 fit into that?
Practice. 0.01 is for learning.
0.01 is for learning momentarily. But you also need to learn how to set the correct lot size, right? There's no math or science behind why a 0.01 except for the hope that you guys don't, because the expectation is you're going to do something stupid and let a trade go, and if you do, it's at a 0.01 and not a 0.1 or a 1.0. How does that make you feel? Do you need your ass wiped? Are you babies? Can you be adults? Right? I'm serious. How about I just tell you what the actual should be and expect that you're adults and you should do that? There's a notion, right? You guys are like, man, he wasn't kidding. He's an asshole. All right. I'm not trying to be, but somebody's got to tell you straight.
So I've known Hiram since the middle of summer.
Yeah.
I made some really stupid decisions, and I had to live through a lot of them.
Yes.
As far as I'm going to go into that.
Yeah.
It is a huge psychological choke to make sure you get the right lot size.
Yep.
Otherwise, you really are freaking out watching everything. But once it happens, you can really now move on because the worst is over. If you don't, once you dial it in, if you come up the other way and can dial it in the right way, or if you do what I did and come down the other way,
Yep.
you learn the right way real fast.
Oh, yeah.
One way is it's scary going into it. The other way, you have a heart attack almost and then come back to it.
Mm-hmm.
But you can get there. And that's
Yep.
the most important thing is to get the right lot size because that's how you're going to go forward either way.
Absolutely. Thank you. I appreciate that. And you're absolutely right. And unfortunately, and for some people, it may be one way or the other. And I'm not saying one way or another. I'm just speaking from a pure logical standpoint, which, by the way, when we're trading is sometimes null and void, right? But there's no math or science that justifies why you should use a 0.01. Matter of fact, some of you guys might be risking so much on your trades that you can't even, like in terms of drawdown, that you can't even justify a 0.01. You think you're safe. And if you did the math, you're like, oh, I'm over leveraging, so I can't take that trade. There's a notion. If it's over leveraged, you just can't take the trade, so you don't trade. Right? Well, we don't want dough in the headlights. You guys understand that, right? If you don't see your setup, you just don't do anything. We're good there? All right, awesome. We're all on the same page. Just want to make sure. Okay. We were watching this SNL skit, and if there was sound, I'd probably play it. But it talks. Man, I can't remember who the actors are anymore. It's an older one, but it's a guy and a girl. And there's their husband and wife, and they're sitting at the dinner table and they're going over their bills. And they're like, man, how do we navigate all these credit card bills? And this guy walks in. It's kind of an infomercial. He's like, it's simple. I wrote a book on it. It's called "Don't Buy Stuff You Can't Afford." Right? And he's like, wait, but what if I want it, but I don't have the money to get it? Should I get it anyways? He's like, no. He goes, well, now I'm really confused. Let's say that I will have the money. I don't have the money right now, but I want the thing. Should I just get the thing and hope that I have the money later? No. He's like, read the book. It's only 1 page long, right? And it's like, don't buy stuff you can't afford. That's right. That's the whole. And he's like, this is just so confusing, right? But it's kind of the same thing with trading sometimes. It's like, don't take a trade that you can't justify if you haven't market replayed it, right? I mean, how many of you guys are taking trades right now that you haven't market replayed? I'm sure a lot of you, because statistically, 90% of you guys are not market replaying, right? That's pretty consistent. But it's all right because Kevin said something earlier that kind of stuck out to me. Kevin Jones, he said, he says, I heard a saying once, when's the best time to plant a tree? Anybody know the answer to that?
20 years ago.
20 years ago. When's the next best time?
Today.
Right now, right? So cool. You didn't market replay, when you first started, but the next best time is right now. Or you can take the data that I have in there and use it, right? Hopefully you still market replay. There's a lot of value there. Okay, so now we figured out dirty pressure. Do we know how to identify it?
Yes.
Do we know when to place the trade?
Yes.
And do we know how to place the trade?
Yes.
With the data, right? Okay. So what we did with this is, so there's two ways to backtest, and somebody's asking about this. There are specific points that you use when you backtest. We call it the golden ratio. And basically what it does is the same thing that most indicators do outside of our indicators. And that's just an autoregressive model. So it takes historical information and it puts it into a formula that says this is what's most likely to happen based on what's already happened, right? Most likely, not average. What's most likely. So it's like weighting, right? and then it creates that evaluation. So we use that same model to figure out if you had a pattern set up and you took it and you tracked it, what data points would we need in order to determine what the most viable stop loss and take profit would be within a risk to reward ratio that makes profit. We call it the golden ratio. Obviously, there's other things that are called the golden ratio. This is just what we call it, right? And so what we expect is that you would collect specific data points. Another way to backtest is to simply determine what your stop loss and take profit are going to be in advance. Now, in doing that, by the time you get done, you either have a yes/no proposition. Yes, it works within a certain risk-to-reward ratio and a percentage of win that is viable, or no, it doesn't. And if the answer is no, then you got to go back and figure out if there's something you can add to it, or just not use it altogether, right? Where if you do it the other way, then you're actually able to compile enough information that you're always going to get a yes out of it. It just depends on how awesome that yes is. Sometimes that yes is not very awesome. Sometimes it's incredible. So for those of you guys that are not part of the mastermind, and those of you guys that are renewing mastermind, we're actually going to, I was talking to my partner, he's like, you should just throw out a promo, because we always do like a Black Friday promo. So we're like, well, it's not Black Friday, and we were kind of waiting for Black Friday. He's like, well, let's just sweeten it up for the event. So he's like, throw it out there, and we'll give him a special deal. So he even came up with a clever name. It's, what did he call it? He probably heard it somewhere. BTBF, better than Black Friday. That's what it is. All right. So normally Mastermind is $200 a month or $2,000 a year. So usually we'll just 50% that, right? $100 a month or $1,000 a year. So for Black Friday, it'll be $1,000, but you're going to get 15 months. So we're doing $1,000 for 18 months, just for you guys in this session, or $800 for the year, or 4 months, $400 for 6 months. So 6 months would normally be $1,200. $200 a month times 6, $1,200. So it's $400. You get 6 months. A year, instead of $2,000, it's $800, and then 18 months instead of 15 months, if I'm not mistaken, would be $1,000. So if that's something that interests you guys, if you guys are interested in Mastermind, getting access to this data, getting access to the alerts. When we send out alerts, do you have Slack on here?
No, it's on my phone.
Let me see if I can remember my login. So these are the alerts for just today. Let's go to the top. So what did we learn today? Dirty pressure? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12. Mark closes at 3 today, so that's probably going to be it. 12, right?
How many of those are winners, typically?
I don't know. I mean, because what constitutes a winner for you may be different for you and for you, right? How many of them are winners would be based on market replay, right? Now, if we went back to the data that we have, we can compare it to that and say, okay, this was supposed to be, based on the data, this is what it was supposed to be. You could use it that way and find out. Yeah. Yes, sir.
I'd also say on that, it says right in there, evaluate on post, because this is a 5 minutes too. And when I've gone in a couple of times, they'll fall apart in the last minute still.
Yep.
So I mean, it's all relevant when the Slack message goes out.
That's a good point. Yeah, it's a good point, because so basically what he's saying is it alerted dirty pressure 5 minutes before you should take it, right? So you're not sitting there staring at your screen all day. You're about your business. You're out at the grocery store. You're on the beach, whatever. You get an alert, and then we can show you ways to remote into your machine so you can see your indicators from your phone, and then switch to MetaTrader 4, place your trade, right? Set your stop loss and take profit, put your phone back in your pocket, and go about your business. So what he's saying is sometimes, even though it sent out the notification, within that 5 minutes it could fall apart and not be there. So it's important that you evaluate. So it's saying evaluate on post and then have exit strategy. And then it always gives kind of like a baseline, short 3 pips or short 5 pips. But that's never going to be, that's rarely ever relevant to the individual trader, because the individual trader has market replayed and then they know what the answer is for them, or they have the data that tells them, okay, for this time, buy, or this time sell. These are what are the most optimal parameters for that specific hour for a buy, for that specific hour for a sell. And this is the percentage of win, and they use that to determine what your lot size should be.
Do the alerts go out 24/7 or 24/5?
Yes, sir.
Or can you turn them off when you don't want to hear them? Or
Yep, you can snooze them. You can, yeah.
It's looking at 6 pairs or how many pairs?
6 pairs. They're major pairs, and we picked them specifically because they have enough liquidity to support larger lot sizes. So remember earlier we talked about beginning with the end in mind. So anything that I set you up with, I'm going to make sure that there's going to be longevity, right? Even as something as small as like how we refer to the pressure lines, because I want there to be longevity in what you're doing. In other words, I don't want to set you up with something today that's just going to be today. We don't do Band-Aids, right? So the 6 currency pairs we evaluated are for longevity. You can put larger lot sizes in them because they have enough liquidity to support them, so you don't have that slippage. And those 6 currency pairs are Euro versus US dollar, Great Britain pound versus Japanese yen, Great Britain pound versus US dollar versus Swiss franc, US dollar versus Japanese yen, and Australian Canadian dollar.
Hiram?
Yes.
Maybe I missed the boat. But if I've never taken a flat top trade, what am I back testing? How, I mean.
So first is identifying, right? So then you identify. So you know how to identify a flat top now? Do you feel? Okay.
Right. I know how to, yeah.
Okay. And then
when I go to place it.
You don't. So remember, let's say I've got the money, or I don't have the money, but I want to buy the thing. Should I buy it anyway? No. So let's say that I have it market replayed, but I want to place a trade. Should I trade it anyway? No. It's difficult. It's a hard pill to swallow.
Okay, so what am I back testing if I've never tested it?
You're back testing the setup. So you go back and you look for it historically.
Oh, gotcha.
Yeah.
Not something I've actually done.
Back test or market replay.
But I'm doing that regardless of whether I've taken that trade before.
You do that. Yeah, you do that. Yeah, hopefully before you ever take the trade, in a live account. If you're doing a demo, I mean, if it's a throwaway demo and it's not anything you're taking seriously, by all means, you know. But essentially, what you're doing is you're taking your charts back to January 2015, right? And then let's say, I mean, are you trading at 3 a.m.? So do you care if something happens at 3 a.m.? So so you're not going to back test 3 a.m. When do you feel like you would have, let's just say, 5 to 10 minutes to trade throughout the day? I mean, are there times where you're in meetings or you're picking?
Morning for the kids.
Okay, so is that like 5, 6, 6:30? Okay, so that means that you're waiting for that 6 o'clock post, which means the 7 o'clock start. So when you back test, you're going to look for the 6 o'clock post. So if you're looking at your indicators at 6:30, then 30 minutes later is when you're going to be making that trade, right? So 6:30, and then what other time? Is that the only time?
No, I mean like early afternoon.
Early afternoon. What about evenings?
Yes.
Okay, so you map out all those times and you figure out what they are in UTC because that's how green chart reflects, right? Now remember, here's just a tip, guys. This says. Let's say this says, what does it say? Oh, it doesn't. Okay, that's all right. I'll use this instead. This says that it is 2100, right? This chart says that right here, this candle is 2100. Okay? That means that it started at 2100. It ends at 2200. Okay? Now that's important because 2100 is 2 o'clock. So if you're trading at 2 o'clock, are you testing the 2100 candle? No. You're testing the 20 candle because the 20 candle ends at 2100 when you want to be in your trade. That messed me up for a little bit too. especially because it's UTC versus Mountain Standard, right? So if you're going to place a trade at 2100 because you're available, so you're available in the middle, so 6:30, so you're going to be available at 7. So you're going to test the 6 o'clock post to see what you're going to do at 7, right? So you want to be in a trade at 7, not looking at what's going to happen at 7 to place a trade at 8, and then so on and so forth. So you always look 1 hour behind. Right now we're 7 hours offset from UTC. So if it's 12, then it's going to be 11, 10, 9, 8, 7, 6, 5. It's going to be 5 a.m. 13, yeah, thank you. 1300 would be 6, and that's the candle you'd be testing to see what you're going to do at 7. So if at 6 a dirty pressure shows up, you're testing that because you're entering that at 7, right? So you go to all the 6s of every day, and then you write down that information. Here's my setup. What did the market do? Here's my setup. What did the market do? It's about 40. Used to be like 70 hours. There are a few things that we could do to help shorten that, like just take blocks like April to August, 15, 16, or 16, 17, and 18. That'll give you a good sampling of just about every market condition as well. April 1st to August to the end of August, 2016, 2017, 2018.
So when you do that, so you test that candle, when it hits the next post, at that time, are you just taking the measuring tool, seeing what it went up, what it went down, and then you had your parameters of just 3 to...
You have nothing. So you have a clean slate. Let's use this as an example right here. Let's say that this is our setup. Let's go back. Let's say that this is our setup, and we're going to go, we're going to see what happens, whatever this is. Say this is just dirty pressure. So right here, we have dirty pressure. So on the next candle, we want to see a long trade. Now our cap is, if it goes 100 pips in our favor without drawing down, then we just say 100 and we stop counting. We don't assume that it's going to go 1,000. Otherwise, it's going to offset our data. We're going to have these big numbers, and then we have a bunch of small numbers. But when you weight that, it's going to be off, right? So we cap it at 100 for max profit, and we cap it at 50 for max drawdown. So if this just goes south on you, and it gets to 50 without ever going into profit, then you just cut it off, right? Now, otherwise, you count how far it went against you and for how long versus how far it went in your favor to its peak. Now, its peak we know is there because it hits that peak and then comes back down to break even or 20 pip draw, depending on, there's a lot of... Man, I'm not doing you any service by telling you this information. It's too complicated. It took me like 3 videos to explain it to my members. There are data points, though. I'm sorry. It's not,
okay.
yeah.
That was my big question, though, was I just really don't know, I haven't backtested them.
Yeah.
It's like, but I know it's important. I just don't know how to do it.
Let's get your feet wet.
Yeah.
So just create a scenario. Just say, you can use a 3 to 1 or whatever, right? You use whatever you want. Because you're going to get a yes, no, and then you'll realize why it's futile to do that. So let's say that we said, okay, we have dirty pressure. We're going to go and back test it for the times that we trade specifically. Can I get 5 pips before it goes 15 pips against me? And then you make tally marks. Yes, yes, no, that one lost. Yes, that one won. You take those and you figure out what that percentage of win is, right? And then you figure out, okay, I'm using a 3 to 1 ratio. Here's the win percentage. Does that equal profit? Right? And it's easy to figure that out because there's risk reward that won't work, like a 3 to 1 with a 70%, or a 4 to 1 with an 80%, right? And there are those that will. So you just figure out which ones will and which ones won't work. And so when you get to the end of that, you say, okay, I won that 70% of the time, but it's not going to work because it's a 3 to 1 ratio. I used the 3 to 1 ratio. Do you see what I'm saying? Where if you collect it more dynamically, when you get to the end, you say, okay, what do I have versus saying this is what I want to see if I can get. You do it dynamically and you say, okay, this is the data. Now, what does it say? Right? It's just a little complicated, which is why we charge. Okay. But it's a good way to get started. And the value in doing that back testing is as you're clicking forward, you start to see how the lines naturally ebb and flow. You start to identify some of the subtle nuances. I don't know if you guys were here on Wednesday night, but we talked about the pressure indicator and its nuances. So all those videos and stuff, all that stuff's recorded and it's uploaded. if you look at the mastermind site, you guys will get sick of hearing my voice.
Tell me about it.
You love me, baby. You love me. All these videos are, so there's from 1 to 115, and then Mastermind archives 1 to just under 100, 92, and then the basics 1 to 41. Those are just the archives.
About how long? Are they an hour long?
An hour to 2 hours. Some of the early ones are two hours. This series was a 5-part series that we did. It's called What is Proper? It talks about proper planning, proper money management, proper analysis, proper exit method, golden ratio. So this is like this one's gonna be ghost written into a book. It's 5 hours long. It's a beast. It was actually almost 8 hours, and then I edited it down to 5 hours. So you think you'll be sick of hearing my voice? I was sick of hearing my voice. That was just that one. Anyway, tons of content in there. Risk calculator. This is something that we developed because it didn't exist anywhere online. They're all messed up. So give me an account free margin. Let's say your account balance. Somebody throw out account balance. 15,400. 15,400. Give me a win percentage. 92. That high? All right, let's do it. 92. And it tells you what your risk percentage is, right? And then give me a stop loss. 50 pips. Your lot size could be 1.23 with a 50 pip stop loss at a 92% win rate, 15,400 account, and minimum take profit has to be 10 pips. It just gives you the information. You don't even have to know how to do the math. Check this out. I believe in my indicators. So if you try to put, let's say you do 70%, it'll give you an output. So 0.15 lot size, you have to minimum of 25 pip stop or take profit. Now check this out. If I go to 69, which is just one under 70, there's no reason why you can't be at 70 or more. It's too stinking easy. If you are, go and figure it out. These indicators work too well to be at under 70%. Don't embarrass yourself. Seriously, like you can take a classic, like the first thing you learned when you got here and hit a 70% win. The dirty pressure that took all but 5 minutes to learn, I mean, you're going to get it 76%, even if it is with the 3-to-1, but you'll figure out how to be well within 70%. We have people that are hitting 80, 85% on those with a 1-to-1, 2-to-1 ratio. Like they're cleaning up. It's simple. It's not easy because the psychological facet isn't something we can teach. It's something you have to experience. But it's simple. And sometimes we have to overcomplicate it just so you can accept that it's that simple. Especially after Tuesday. Especially after this coming Tuesday. It doesn't get any simpler than that. If you don't make 6 figures on that, I don't know what your problem is.
I took a class in high school, American history. Every day, the teacher just put up slides on the board. We just copied down the slides. We could use our notes on the test. Only 4 of us aced the class.
Holy cow! Man!
And that's what you're saying on Tuesday.
That's it. So, yeah. It sucks, but it's not really my why. It wasn't my why for being here. And yes.
This is just my opinion on this. The real value in this, in my opinion, is that archive of video. The alerts are great, but quite frankly, you can sit down and look for them yourself. The trade setups are fantastic. They're there. But once you've got that, you're done. I mean, you know what the patterns are. It's those videos with all of the learning, all of the intense, in-depth analysis that's going on with those, where the real value is in this, in my opinion.
Thank you, Dr. Zed. I appreciate that. I appreciate it. And we've spent a lot of time on it. We take every line of the indicators and we do advanced indicator training. And so we'll explain. I mean, I've got videos on just the thick orange, just the thin orange, just the blue dotted, just the pressure indicator, just a major minor indicator, like so on and so forth. So we've got it's very extensive, but I appreciate that. Thank you, guys. I am out of time. I hope you guys enjoyed the session. Hope you guys learned something, have some takeaways. Thank you. I appreciate it. Thanks. Thank you. And if you guys have any questions after the session, I think I've got some cards. I'll give them to you guys. Can email me. I'm always available to talk to members, regardless of. I mean, maybe in a year from now, if I'm on my couch drinking whiskey, you probably don't want to ask me too many questions and expect a viable response. But thanks, guys. Have a good one.